The jobs report threw a bit of a wrench into last week's roller coaster, but we ended on a strong note after a better than expected inflation report. The good news, while the headline jobs number looked quote unquote strong, there are some underlying cracks investors are paying close attention to, and those details could actually add fuel to the mortgage rate rally. Good afternoon. We're officially halfway through the month, and momentum is starting to shift in our favor as the housing market begins to heat up. Last week brought a wave of economic reports that had meaningful impact on both mortgage bond and treasury markets. As a result, we've seen the 10-year treasury, which is one of the best indicators for the direction of mortgage rates, fall to 4.04% to start this shortened holiday week after hitting a high of 4.27% just last week. We've got another gauntlet of economic data ahead of us and plenty to unpack from last week, so let's dive in. Here are your headlines. January's job report from the Bureau of Labor Statistics showed 130,000 jobs added, more than double the 55,000 expected. The unemployment rate edged down from 4.4 to 4.3%. But what is the bigger picture? At first glance, the headline number looks solid, but when you dig a little deeper, the story becomes much more mixed. Conflicting labor data, downward revisions, and heavy seasonal adjustments suggest the underlying trend may be softer than it initially appears. ADP reported just 22,000 private payroll gains last month, while Revelio showed a decline of 13,300 non-farm jobs. Job openings dropped sharply to 6.5 million in December. On top of that, Challenger, Gray, and Christmas reported the highest January job cut since 2009, along with the lowest level of January hiring announcements since they began tracking the data 17 years ago. Revisions also matter. November and December payrolls were revised lower by a combined 17,000 jobs. More notably, total job growth for 2025 was revised down by 403,000, leaving just 181,000 net jobs created for the year, or an average of only 15,000 jobs per month. Then there's the seasonal adjustment factor. January typically sees large job losses as holiday and seasonal workers are let go, so the BLS applies a sizable adjustment. In the raw data, payrolls actually fell by 2.65 million jobs. After applying January's adjustment, that decline translated into a reported gain of 130,000 jobs. So in short, while the headline appears strong, the underlying data tells a more cautious story, and that nuance is that the labor market continues to be weaker than what the headline reports say. Now, consumer prices rose 0.2% in January and 2.4% year over year, down from the 2.7% in the previous CPI report and marking the lowest annual rate in 8 months. Core inflation, which excludes food and energy, increased 0.3% for the month and eased to 2.5% annually. Shelter remains a key driver of inflation, accounting for 35% of headline CPI and 44% of core CPI. Because of this heavy weighting, even small changes in shelter costs can significantly impact overall inflation. Shelter readings were modest in January, helping push the annual rate lower. Airline fares, however, jumped sharply and added some upward pressure. The next inflation reading we will be getting is the Fed's preferred measure of inflation, the PCE, which will be released on Friday. A few other reports that came out last week had a big impact on the state of the economy, and that was weekly jobless claims and retail sales. While strong retail sales in November signaled a solid start to the holiday shopping season, December's results fell short. Sales were flat month over month, missing the expected 0.4% increase, and 8 of the 13 retail categories reported declines. Initial jobless claims fell by 5,000 to 227,000, while continuing claims increased by 21,000 to 1.86 million. Continuing claims have remained elevated for an extended period, suggesting unemployed workers are taking longer to find new opportunities. Taken together, softer retail spending and persistently elevated continuing jobless claims suggest the economy may be losing a bit of momentum as we continue to head into the year, something markets and mortgage rates will be watching closely. We're finally seeing some momentum shift in our favor, with rates dropping to their lowest levels since December as we head into the busiest time of the year, the spring buying season. Recent economic reports, along with optimism surrounding the new Fed chair stepping in this May, are creating a sense that this could be a strong year for real estate. With that being said, keep hustling and let me know if there's anything I can assist with. I'll be back in touch next week with another update, but for now, have a great rest of your day.